Hi guys, welcome back to my YouTube channel. Thank you so much for tuning in. Today I've got an exciting guest. Her name is Sipokazi. She's a registered tax practitioner, and today we're just going to cover the topic of how to be tax efficient in terms of investing, planning for pension or retirement, and just how to be tax efficient. Sipokazi, welcome. Thank you so much for joining me.
It's a pleasure to be here. Thank you for inviting me.
So let's get into it, Sipokazi. When someone is, let's say, a working professional, what are some of the things that you need to be aware of to ensure that when you're investing, you're being tax efficient in how you're doing things? What are some of the things that we need to consider?
So when you're a working professional, I'll first start with people who work for maybe companies that provide them with a provident fund or a retirement annuity, a provident fund or pension fund. So most companies would give you a limit and say this is the minimum you can contribute to your pension fund or to a provident fund if they have one. The nice thing is that now, since 2016, government has made the provident fund and the pension fund rules to be the same. So you get a deduction for your pension fund contributions, whether you're in a provident fund or in a pension fund. So if your company allows you to have flexible contributions, so you can increase your contributions beyond the minimum that is given for employees, I think if someone can take that benefit into account, that will really help. So, for example, when you contribute into your provident fund or pension fund, some of the costs of running that provident fund and pension fund is funded by your employer. So instead of maybe having a provident fund contribution and also going outside and doing your own RA, it might be advisable that instead of contributing for your own RA outside with other service provider, you take opportunity of the flexibility that you're given by your employer and you contribute the max amount with your employer. In that way, you are saving on costs, on the cost of paying your external service provider, your admin fees and so forth. And that your growth in your provident fund or your pension fund can grow much quicker because of the higher contributions you make. So in that sense that you will then reduce on fees. Now there's two differences. So if you contribute into your pension fund from your employer, your net income on a monthly basis, your net pay will be much lower than when you're contributing outside to an RA. So that means that you'll be contributing to your pension fund, but you'll be getting your refund on a monthly basis through your payroll. So instead of when you the difference is when you're contributing to an outside RA, you will only get your refund from the receipt of revenue when you submit your tax return. But when you're doing it through your employer, it's factored on a monthly basis, and you get that refund on a monthly basis from your lower taxable income. So that's one of the things that you can do. The other thing you can do is if you're part of a medical aid, you need to keep documentation of all the medical costs that you do incur that are not funded by your medical aid. So sometimes when you go to the doctors, some medical aids will refund you if you do pay upfront half of the amount that you pay to the doctors. So you need to keep proof of all those expenses that you incurred, and when you do your tax return, you then claim the deduction for all the expenses that were not covered by your medical aid. The other thing is that some of us, we have parents who are older, who we may be paying for the medical aids. You can also claim that cost. So if you're paying for your elderly parents' medical aid contributions, even though they're not under your medical aid, they have their own medical aid. The receiver, the SARS, allows you to claim the contributions that you've made on behalf of your parents. So that's also a benefit that you can take. And if you have siblings, like your close-knit family, your siblings that you have insured, SARS will allow you to claim that benefit. So that's the second thing. The other thing you can do is if you do donate to the non-profit organizations, so you will get a deduction for all the donations you've made. So as for individuals, for individuals, you can donate up to 100,000 rand per annum, donation tax free to any organization. So if you make donations up to 100,000, you don't need to pay donations tax. So that's another way you can reduce or be more tax efficient. Then there's other ways. If you, for example, you earn interest, you claim the interest income exemption from SARS, and other ways is so. The other ventures, like for example, your 12J ventures, it's for people who already have lots of money, I can put it that way, to invest in 12Js. So for the high net earners, they can look into 12Js as another source of making themselves more tax efficient.
Brilliant, thank you. I think you touched on something which is very key for me, that interest exemption. So I know for me, for example, my goal is financial freedom, and I don't want to wait until retirement to enjoy my money. So one of the ways I'm looking at is how can I invest my money now whilst being tax efficient. So I know a lot of people talk about tax-free savings, and usually people that can you just highlight the difference between if you're obviously using a tax-free account as a savings account and not an investment account, compared to a normal savings account where you get the interest-free exemption on an annual basis, and how can people do it a bit more smarter?
Okay, so on an annual basis, SARS gives individuals who are 65 years and younger 23,800 per annum exemption from interest. So if you have investment income that you're earning from some of your investment, let's say you've got a money market account, you've got a fixed deposit, or you've got a savings account, and you earn interest on those accounts, then SARS says the first 23,800 that you've earned, you don't need to pay tax on it. You start paying tax from 1 cent above that limit of 23,800. So it's more beneficial for us as individuals when we do open a tax-free savings account, that we don't use it as part of the money market account or a fixed deposit or normal savings account, because you already have this benefit that SARS has given you to say, you can have this interest exemption. So for me, I think it's more beneficial for us and more tax efficient to use a tax-free savings account for things like your exchange of traded funds or your unit trust, or you buy shares on your tax-free savings account. My advice is for tax-free savings account, do not put it in any interest-bearing product, because you have an interest exemption. So you're not utilizing that exemption to the fullest. Rather, utilize the interest exemption for all interest income that you're earning up until 23,800, and use your tax-free savings account for your ETFs, your unit trust, or any other product, let's say, or any other equities, shares, and so forth.
Thank you for that. So tell me, you mentioned 100,000, I think, donation that you can claim if you've donated to an organization. Do parents or close family count as well? Can you claim that from as part of the donations tax?
So the legislation says you have up to 100,000 rand to if you want to donate to any individuals, your family. Sorry about that.
Okay.
Can you hear me?
Yes, I can hear you. Do you mind shifting your camera just a little bit to the right?
To the right, okay. Is it better?
No, sorry, the other way then, I think. Because I want you to be in the middle. Yeah, there you go.
Okay. So there's two distinctions, right? So the Income Tax Act says you can donate to anyone up to 100,000 rand without paying donations tax. So I can give money to my mother, to my sister, or to my kids, or any other nonprofit organization up until 100,000 rand without paying donations tax. Once I start donating over and above 100,000 rand, then I become liable for donations tax. And then you need to start paying donations tax to SARS. So you can only claim a deduction for donations if you are donating to organizations that have been approved by SARS. So SARS has a list of all non-profit organizations that they have approved as that you can donate to. So once you donate to that charity or that organization, they will give you a donation tax certificate. And when you fill in your tax return, what will happen is you will need to then state to SARS, I donated 1,000 Rand to whatever foundation. This is the people, SARS will want the PPO number of the organization you donated to. So then you need to stipulate the PPO number. Mm-hmm. Now, I know a lot of people would say, I want to open up a tax-free savings account for my daughter or my kids. How can I do it? So if you're going to contribute to a tax-free savings account on behalf of your children, that falls under donation. So any amount of money you give to your kids, it falls under donation. So you can contribute, let's say you've got 3 kids, you can contribute to a tax-free savings account for your kids, but you need to be aware of the limitations of the 100,000 Rand. You can contribute to your children's tax-free savings account as long as all 3 of them, when you have contributed, you don't go over the max of 100,000. Mm-hmm. And I think that's something that we as individuals are not quite aware of, that if you're going to give monies to individuals, whether it's your parents, friends, or your siblings, if you're going to donate to them, make sure whatever you give them is not above 100,000, so that you don't need to pay donations tax. Okay. And the nice thing is that the donation tax limit is on an annual basis. So you can limit, then you can plan how much you give to people, so that you don't then become tax inefficient. If you want to give your parents money, give them up until that limit, and then say, next year I'll give you more, and every year I'll give you some donations, so that you can be tax efficient. So not all, I just want to stress this point, not all donations are deductible, only the ones that have been approved by SARS, and they can issue you with a Section 18A certificate.
Okay, thank you for that clarification. I think it's so important. I want to talk about, because I know some of us have properties, rental properties that we rent out. I know I've sort of documented my disastrous property investment that went wrong. How do you make sure, because I know people usually ask, do I pay off the house that I'm staying to be more tax efficient, or do I pay off the rental property faster? What is the implication of paying off a rental property that you've invested in off faster? What are the tax implications regarding that?
Okay. So my philosophy, if you're going to have rental property, you need to pay off the bond over the longest period possible. So if your bond is over 20 years, and if you know that this property, you're going to use it as your rental property, this is investment property, pay that bond over 20 years, because then the interest works for you. So from a rental property perspective, SARS allows us to claim the interest expenditure on our rental property. And as we know, with bonds, the first 10 years of your bond, you're actually paying interest, even on your monthly installment. 80% of that monthly installment is actually interest payments. So if you buy investment property, for the first couple of years, that interest deduction will help you to be in a tax in a tax loss for your rental property, because then you're going to have this high interest expenditure that you can claim from SARS. You can also claim all your agency fees. So for example, if you've got an agency that's managing your property, you can claim those expenditures, those expenses from SARS. You can claim your rates and taxes that you pay on your property from SARS. You can claim your levies if you live in a property that you pay levies for. You can claim the levies. And also insurance, so your building insurance. Only your building insurance you can claim that as well. Also, if you're paying a bookkeeper to manage your books, if you've got more than one property, even if you've got one, if you've got a bookkeeper, you've got accounting services, you can also claim that. So all of those expenses in the first couple of years when you do lease out a property, those expenses become, when you add them up on an annual basis, they're much higher than your rental income that you got throughout the period. So you will then be in a loss for your rental property. Now that loss in most cases they're not, you can then, when you're submitting your tax return, SARS takes that loss against you, all your other income that you've earned, whether your employment or what other income or from investment, it then reduces your taxable income. So in a way, you're becoming tax efficient. But SARS can, there's a section that in the Income Tax Act where SARS can ring fence that loss and say, you will not be able to utilize this loss against your other taxable income up until a point your property makes taxable income. Now SARS does that when SARS does that, it's called suspect trade. So SARS can do a suspect trade on you. Let's say you've got one property or you've got two, and SARS feels that you are letting out your property at a lower rate or to lower rental rates than you would have let out at lower rates than in the general market. So sometimes if you're leasing out a property to your family or to friends or someone closely connected to you, and let's say the market rate for that unit is 8,000 Rand and you're leasing it out for 4,000 Rand, then SARS deems that as a suspect trade because they're saying you intentionally renting out your property at very low prices so that you can accumulate losses to offset your other income. So you need to then make sure that you're renting out your property to third parties, and also you are charging market-related rent for the unit or for the area that you live in. And then SARS will say, okay, fine, you've got a lease agreement, we see that everything is in order, you are leasing this property as if you are leasing to a third party, and your losses are genuine losses, then they would then allow your losses to offset your taxable income. And that comes quite handy because then you might find that you got a loss of 15,000, 20,000 when you rent a property, and it reduces your taxable income that you need to pay to SARS. So it's quite a nice way as well to be tax efficient. Now for the property that you live in, your primary residence. So for your primary residence, you can't claim the interest for the property that you live in. You don't earn any income from that property. So I would encourage people, if you know that this is your primary residence, you're not going to sell this property, you're not going to rent out that property anytime soon, then I would encourage you to pay down the interest as soon as possible. So with a primary residence, SARS gives us 2 million Rand over our lifetime as a CGT exemption. So when you sell your primary residence, then you can use it and you make a profit, you can use some of that 2 million Rand as a CGT exemption. So that exemption is over your lifetime. It's not per property you sell. So let's say, for example, I buy a property today. I know in 5 or 8 years' time, I want to move out of that property and buy another one and then rent it out. If you know your intention in the long term that you're going to move out and rent out the property, I wouldn't suggest that you pay off that property quite quickly. But if you know that I'm here to stay in this property for the next 15, 20 years, rather pay the property off and save on the interest.